lower returns. It might even turn negative, quote unquote. This is according to the Norwegian whale. We just have to accept that. The future will be less attractive for us than the past. He also added the biggest potential problem for the fund, the world's biggest owner of publicly traded stocks, is inflation, and predicted surging prices could have far more serious consequences than is currently generally assumed, quote unquote. I see inflation everywhere. In freight rates, in the prices of metals and food, in construction costs, and gradually in wages. As a long-term investor, we don't have that many options, he added. We have nowhere to hide from inflation. And of course, this Norwegian whale fund is the largest in the world, with over 9,000 stocks in their portfolio. So when they talk, we have to listen. But I know. What does this Norwegian whale knows about anyways? We, the Robin Hoodies, we know what's up. We know Papa Jerome's on our side. He's just bluffing. He's never gonna raise interest rates, and therefore we have to go all in. Call options, blindfolds on, heads first, no style. Just like the old days of last year. Options trading activity hits record, powered by retail investors. But most are playing a losing game. Which you know that you lead, right? Which you know. What's up with the fund? A record of 39 million options contracts are traded daily. Wow, daily on the average this year, rising 35% from 2020. And retail investors now account for more than 25% of this trading activity. However, the majority of these small-time traders are buying the most basic call and put options, which have a much lower probability of profit compared to advanced strategies like option trades. Everybody in the business knows that if you're only buying out-of-the-money calls, then you are likely going to lose money over time, said some fund person. Because you know, right? Buy out of the money, weekly expiration, to the moon. And the problem is, you've been buying call options out of the money with weekly expiration on meme stocks, and that worked in the past, but it's not working so far. You can see the explosion, the mania of options trading. You're not interested in holding stocks, you're not interested in investing, not even interested in trading. They're just brainless zombies, high meth, looking for the next score. Give us the ticker, bro. Give us the next call options we're supposed to buy out of the money weekly expiration for 10 cents a piece. That's gonna blow up from 10 cents to $10. This is, of course, gonna end up in a disaster. Here's a piece of advice, by the way. If you're gonna buy out of the money call options naked, you get a chance of profit of about 25%. However, if you use spreads and you buy closer to the money, your chance of profits moves from 25% to 40%. A little worse than blackjack, but hey, the casino's too far. I like the casino at the tip of my fingers. Robin Hood. But, and this is the big but, perhaps there is a glimpse of hope here. The retail investors are getting more disciplined because we're seeing an interesting phenomenon here. Traders turn to derivatives that protect against US market fall. What does that mean? Investors are buying put options in ever greater numbers as they seek to avoid losses after this year's strong equity rally. After you get shot in Peloton, Zoom, RKK, the Oval stocks, GME, AMC, now they're learning that perhaps want to buy some put options here for protection. Look at that. Put options are surging higher, specifically on individual stocks, not the indices yet. As you can see, the gap between call and put options volume has started to shrink, and this is not a good sign for the stock market, folks. As you can see, when we get the negative readings, that means that we're going call options. And along with the coke, this strategy has supported the market to go to the stratosphere, the mania territory, vertical rally higher for almost 2 years now. But look what's going on here. We're having the saucer bottom, moving higher, and that reading is about to pop the positive territory. When that happens, it comes hand in hand with a crash. All of a sudden, everybody scrambles to buy put options as the crash starts to happen. Investors are increasingly turning to a tool to protect them if the US stock market careens lower in the coming weeks. Traders are buying put option contracts in ever greater numbers, hoping that the derivatives will provide a hedge if stocks fall from record territory. The rising use of put options contracts, including by the swell of new retail day traders who entered the market this year, has accompanied a surge of volatility in the $53 trillion US equity market. Now, can you imagine what will happen if retail traders start to roll put options, inducing reverse gamma squeezes in the market and crushing the rich in the Wall Streeters? They will ban retail trading like that. They will ban Robin Hood. They will probably take us to jail. But so long as we are the useful imbeciles who are pushing stocks higher by YOLOing and then holding the bag after that, the oligarchs are okay with that. That's totally fine. While the S&P 500 has advanced by more than 27% this year, setting a new record on Monday, those gains have not been evenly distributed, and many investors who stepped in to buy dips have not been rewarded, aka catching a falling knife. More than 200 of the companies within the US equity benchmark are down at least 10% from the recent highs, with close to 90 of those S&P 500 companies off at least 20%. That has been one signal for some traders that the so-called everything rally is not as durable as many of the benchmark indices have made it appear. It used S&P almost at all-time highs, but individual stocks not so hot so. Customers made a ton of money buying calls and speculating over the past year or two, and now that doesn't work anymore, quote unquote, said Henry Schwartz, the head of product intelligence of the exchange owner of CBOE. He also added, how many customers can successfully shift into strategies that will do well in a sideways or down market? Question mark. The answer is not so many, because the majority of these traders and investors have not seen a bear market yet. Goldman Sachs strategist Vishal Vivek noted that single stock put options trading hit a record $353 billion on December 3rd, and that average daily trading volumes of $233 billion in November was an all-time highs. Vivek added that the $217 billion daily put options volume, as the average of course in December, remained elevated despite a decline in single stock call options, quote unquote. There are signs some of that buying is coming from retail traders. Yep, we're buying puts. An increasing number of small-sized options trades, which investors have used as a gauge of retail investor activity, have been for those new put contracts. Let's YOLO puts. Jason Geopervert of Seaman Trader estimates that roughly 23% of new retail options contracts open in the new week ending December 17th were for puts, up from 16% at the start of November. So we're increasingly buying puts here. But is it really retail traders who are buying the puts? We'll answer that in a second. But it is a flexibility that people don't think retail has, said Peter Van, whatever that is, the hedging specialist at hedge fund Man Group. He also added they think of retail as knee-jerk buy the dip call buyers. But we are seeing that sophistication, quote unquote. Van, whatever, added that it was not simply retail traders turning to the options. Big money managers have also gravitated to put contracts, using them to hedge their portfolios instead of treasuries, giving the view that the US government debt has little room to rally in the event of equity market drawdown. The number of put contracts outstanding has climbed by more than 25% since the end of 2019, according to data from CBOE Global Markets and Option Metrics. And there is a sense that even new retail traders are not exhibiting some of their old habits. When buying call options, the swarm of retail traders often opened and closed option trades on the same day. And this is, of course, in a bid to profit on the price swings of the option, as opposed to making a long-term call on the movement of the underlying stock, aka gambling. That's all there is. While that has been partially true on the put side, strategists and traders said there were signs these small traders were also using the puts, listen to this, in the more traditional sense, holding puts to hedge against the sell-off. And notice while the S&P 500, the Qs, at all-time highs, this year has been an excellent year for investing if you bought the right stocks. But if you bought 2020 stocks, the YOLO, the mania, not so hot so. This market is killing me, quote unquote. Reddit user Cold Donkey 4784 wrote on the message board Wall Street Bets. In a discussion about how to make profits, sometimes referred to as chicken tenders, quote unquote, using options trades. The person said, I am a bull by nature, but I am happy to use puts if it makes tendies, quote unquote. But you know, with all of this fun, this is all garbage, of course. This is what do they know, right? What do they know, these put options buyers? What do they know? We, the Robin Hood, no. The market only goes up. And I agree. You don't have to listen to the fun, by the way, because you got the criminals at JP Morgan on your side. JP Morgan says investors are too bearish. No sell-off in sight. Relax, rest assured, put your blindfolds on, run Naruto style, heads first, and continue to buy calls and individual stocks. Meanwhile, JP Morgan clients, you know, the rich, well, apparently, they want to own a little less of the everything bubble in 2022. What does that mean? JP Morgan says, rest assured, continue to buy. And they want you to buy the bags that the rich is about to hand to you. And let's conclude with this. This article from this gentleman, whatever his name is, doesn't matter to me, about the rise and the upcoming fall of retail investing. Retail investors riding the bull market could spur a populist backlash. This is the headline. Arguably, the bull market of 2021 is the same one that started in 2009, with one big change. Retail investors, who sat on the sidelines for so many years, rushed in after the pandemic-induced flash crash last year, and have since been buying every dip with mounting enthusiasm. They represent not only a new cohort of investors, but a new voting bloc, increasing the risk of a populist backlash should one of the dips turn into another bear market. Are you saying stocks don't only go up? They lied to me. Remember that policymakers played a big role in starting this craze via insider trading, of course. They bought ahead ahead of time, you see. Flush with government support checks and fresh liquidity from central banks, new investors began pouring a part of their income into markets, helping to turbocharge the bull run into a 13th year. More than 15 million Americans downloaded trading apps during the pandemic, and surveys show many of them are young, first-time buyers. Retail investors have also been hyperactive in Europe, doubling their share of daily trading volume, and in emerging markets from India to the Philippines. All told, U.S. investors alone poured more than $1 trillion into equities worldwide in 2021. 3 times the previous record and more than the prior 20 years combined. After retreating last decade, and they retreated for a good reason, by the way, they've been holding the bag from the dot-com bubble and the 2009 crash. U.S. households overtook corporations as the main contributors to net demand for equities in 2020. They now own 12 times more stock than hedge funds. Whoops. Media coverage tends to peak at the zaniest moments, such as when the Robinhood crowd was going gaga for GameStop and the other meme stocks last winter, and the craze never slowed. Retail investors' quote-unquote interest measured by internet searches for popular market news and trading outlets has continued to climb skyward. U.S. households bought an astonishing pace throughout 2021, peaking in the third quarter when their stock holdings rose by more than 16% over the previous year. That level of new retail flows matches the prior record set in 1963. Google what happened after that. Anyways, alas, going back to the crash of 1929, one common feature of bull markets is that retail investors catch on too late. Yep, today they continue to buy even as corporate insiders are selling in record amounts. The rich dumps, the poor buys, with insider sales topping $60 billion this year. And insiders have the opposite record. They tend to sell at the peak. Duh. Should the market turn sharply, the fact that high-profile CEOs moved to reduce the risks in time will only serve to encourage outrage among smaller investors who did not. On top of that, remember this. The Fed also caught insider trading, and they dumped almost at the top. Oh boy. Instead of counseling caution, however, Democrats and Republicans, in a rare bipartisan show of unity, have cheered the quote-unquote democratization of markets and defended the right of Americans to speculate freely on meme stocks, even if it seems irrational. These sons of bitches are rubbing their hands, licking their chops, waiting for you to hold the bag. If you make them richer, if they can use insider trading, insider information, to also YOLO call options and profit on your dime, and then dump at the top and leave you holding the bag, why not? Of course, we have bipartisan show of unity, but here's where it gets more dangerous. Another warning sign from pending trouble for the markets is heavy borrowing to buy stocks, or margin debt. Net margin debt in the U.S. now amounts to 2% of GDP, a high since the record began 3 decades ago. Are you paying attention or not? This will be the biggest crash in history. A large chunk of it is on the tab of retail investors. Their borrowing to buy stocks rose by more than 50% over the past year to record levels, much as it did before the crashes of 2001 and 2008. But many retail investors are placing their bets in a highly speculative way, for example, by buying one-day call options or stocks with low nominal value and easy lever up. It is a surreal sign of confusing times to hear avowedly socialist political leaders defend extreme capitalist risk-taking by a class of investors that includes many lower and middle-income voters. You know why? Because there is no Republican Party, there is no Democrats Party, there are no progressives, they're all the same criminals. They work for the same team, the 1%, the oligarchs class. That's all there is. The result is a market that is historically overvalued, overowned, and to a perhaps unprecedented extent politically flammable. Americans now have an unusually high level of savings, and the share of their portfolios that they hold in stocks now matches the all-time high, going back to 1950. Now here's a note to all of these Wall Street financial media writers. When you write something, have the confidence in your call, because they write all of this FUD, all of these facts, by the way, not just FUD, these are facts. And then at the end, they retreat, and they write the paragraph. You just wrote a whole column, and you contradicted yourself at the end. Why? Because you're scared. You're scared of being wrong. You're not bold. You're afraid of calling things, and then you turn out to be wrong because the mania extended for a few more weeks or a few more months. Have some confidence, for the love of God. There it is. None of this necessarily portends an imminent crash. There is still plenty of liquidity sloshing around the system, and even some of the most sophisticated investors fret. There is no alternative to owning stocks with interest rates so low. We've heard this garbage for a long time, by the way. I will show you articles from 1999 and 2000, right before the crash. They said, buy the dip because the cash on the sidelines. And guess what happened after that? The cash on the sidelines is important, but it's not as important as the cash in the game. And when that cash comes out, it's a tsunami that dwarfs whatever cash on the sidelines. Anyways, but having done so much to inspire this retail investor mania, governments and central banks could face a major backlash when the next bear market inevitably arrives. Now, let me fix this pussy paragraph for you. I actually shouldn't say pussy because the 3 ladies who are watching the show are going to get offended. What's up with the sexism, bro, right? Pussies are strong and durable, and they take the beating and pop babies and do other magic tricks. I get it. Let's use another organ, a little above the waist, perhaps. How about eyeballs? They're sensitive, right? Let's remove the eyeball aspect of this paragraph. Here we go. And folks, the bottom line is, the level of arrogance and overconfidence by retail investors is unprecedented. I've never seen this kind of overconfidence in my life. Just read the comments once in a while on this channel. Powell is not going to taper. Powell would never raise interest rates. Markets only go up. You got to continue to buy the dips. Yada, yada, yada. And then when they catch a falling knife and the whole house crashes on the little heads, they're going to come out and say the system is rigged, the markets are manipulated, JP Morgan cheated us, the hedgies, Jerome Powell stabbed us in the back. He already told you that this will happen, but you didn't listen. So you have nobody else but yourself to blame here. Greed is not good. And with that out of the way, let's start the markets coverage, starting with the performance today. And here we go. We have some divergences today because the Dow was up 95.83 points, or a gain of 0.26%. On the other hand, the Nasdaq was down 89.54 points, or a decline of 0.56%. The S&P 500 was also down by 4.84 points, or a decline of 0.10%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, utilities, and number 2 for the silver, defensives. Number 3 for the bronze, REITs, and the laggards of the day led by technology, communication services, and healthcare. Obviously a defensive theme in the market today. What about the advanced and decline ratios? NYSE 52% advancing versus 45% declining. The Nasdaq 36% advancing versus 61% declining. All for breadth in the Nasdaq. And it has been that way for a long time, by the way. This is a leading indicator that it's just a matter of time before the big caps start to fall apart. Moving on to futures. What's going on here? We have modest rallies here in crude oil prices. WTI up about 0.5 percentage point. Brent exactly 0.5%. Gasoline prices, heating oil prices were also up. On the other hand, natural gas prices traded down almost 2% today. We continue to follow on the tensions between the U.S. and Russia and natural gas prices. And so far, gas tankers have been rerouting from Asian destinations to European destinations to take advantage of the arbitrage in prices. Natural gas prices in Asian markets are well below, I should say, European gas prices. But we have to keep in mind that we have record freeze in the Pacific Northwest in this country, my former hometown, and record snowfall in California. Yep. So again, these heating oil and gasoline prices will continue to go higher if temperatures continue to drop in other territories in the country. By the way, we have another storm that's about to hit the south around New Year's Eve. What about softs? What's going on here? Lumber futures are exploding higher by almost 8% today alone. This is concerning, folks, because inflation is obviously not transitory. But if they celebrate a drop in the CPI in December due to the dip in energy prices, watch out, because energy prices are reinflating again, just as lumber did. We have some modest gains here for cocoa futures, almost 1% to the upside. Meanwhile, we have losses led by cotton, sugar, coffee, and OJ. What about metals? No notable moves here, besides palladium moving higher by about 2% and copper losing some of the gains from yesterday. But when we talk about gold and silver, pretty much on the flat line because the dollar is not moving either. What about meats? Live cattle futures on the flat line, while we have some gains here for feeder cattle futures and losses of almost 1% for lean hogs. What about grains? Muted activities for soybeans across the board, yet we have gains for canola and rough rice futures. On the other hand, losses, big ones for oats, followed by wheat and corn futures. Moving on to the big casino, the options market. What's going on here? Leading the pack, the hottest stable by far, per usual, is Apple, with a little over 1.2 million contracts traded today. About 72% of those were calls. Tesla, the souffle, number 2, with a little over 600,000 contracts. About 61% of those were calls. And number 3, Nvidia, with almost 500,000 contracts traded today. About 69% of those were calls. The action remains heavily tilted toward calls, and these are, of course, weekly calls. What about the unusual activities that took place in the options market today? Starting with the ticker SPY for the S&P 500. They're buying puts here, the 375 puts, the expiration date February 4th, with expectations that the SPY will drop down by more than 21.5% by then. This is in all likelihood, by the way, an insurance trade. Somebody's hedging by buying puts in SPY. But anyhow, they paid about 50 cents a piece to enter this trade. All in all, spending about $650,000. What about the ticker PTON, Peloton? What a disaster the stock is. Probably going to zero. They continue to buy puts here, adding more pain to the misery. In this case, buying the 33 puts for the expiration date January 21st, with expectations that Peloton could drop down by more than 6.5% by then. They paid about $2 a piece to enter this trade. All in all, spending about $1.7 million. And what about the ticker BBIO? And this is for Bridge Biopharma. The name is down almost 90% year to date. But today we saw a pop, perhaps some profit taken by shorts, some tax planning, and somebody's betting that we have more gains to come here by buying the $15 calls for the expiration date January 21st, with expectations that the name could pop higher by more than 14.5% by then. They paid about $1.35 a piece to enter this trade. All in all, spending about $700,000. What about the trade for the ticker TQQs? This is the leverage index for the Nasdaq, the QQs. They're buying puts here, really interesting. The 160 puts for the expiration date January 7th, with expectations that the name could drop down by more than 7% by then, and they paid about $2.15 a piece to enter this trade. All in all, spending about $1 million. At the bottom of the table, what about the ticker QQQ? No leverage here. The regular QQs. They're also buying puts, betting for a pullback. The 366 puts for the expiration date February 18th, with expectations that the Qs would go down by more than 9% by then. They paid about $4 a piece to enter this trade. All in all, spending about $2 million. Continuing with interesting trades, what about the ticker mRNA Moderna? They continue to pile in here, more pain from Moderna by buying the 215 puts for the expiration date January 21st, with expectations that Moderna could go down by more than 11% by then. They paid over about $8 a piece to enter this trade. All in all, spending about $3 million. And lastly, at the bottom of the table, what about the ticker AMAT for Applied Materials? The buying calls, the 170 calls for the expiration date February 18th, with expectations that the name could pop higher by more than 6% by then. They paid about $5.25 a piece to enter this trade. All in all, spending about $1.8 million. Moving on to the heat map analysis. What's going on here? Obviously, lots of pain, lots of selling and profit taking in the technology sector of the market. And the losers, once again, the Chinese stocks, the Zooms and Pelotons of the world, the RKK, even some of the winners, the pandemic-related winners, Pfizer and Moderna, also being beaten down, along with the diagnostics like Thermo Fisher, TMO, Abbott Laboratories also down. Now, what's working today? Value, the likes of IBM, for example, Dell, Disney. These are the names that are working along with the defensives. We're talking about some industrials here, materials, utilities, REITs, and consumer defensives. Of course, part of defensives is the old school big pharma names. Forget about Pfizer for now. This is going to move up and down based on the varied news. But we're talking about Johnson & Johnson, Merck, AbbVie, Bristol Myers. These are continuing to work along with the healthcare providers, health insurance names, the likes of United Health. I am moving on to the charts analysis, starting with SPY, 30 minutes chart. What's going on here? We're seeing some consolidation here. The market gapped higher in the morning. It sold off midday. We had some selling program. But again, the path of least resistance under high volume is higher. And therefore, we did not see a follow-up after the program took place. The chart is also working out some of these overbought conditions in certain charts. But there is more work to be done. And the question is what we're seeing right now a series of bull flags followed by a bear flag top in formation? That remains to be seen. It is a weaker formation because the volume is down. We did not see a follow-up after the program took place. The support for now remains 470. The resistance, the sky's the limit because the chart is already at all-time highs. Here's the daily chart for the continuous contract, the SPY. What's going on here? It is still trading above the bull to bear advantage line, which happens to be 4,657, which means that the bulls still have the advantage here. The momentum indicators are strengthening, but look at that pop higher. Vertical line higher. Massive rally with little to show on the hour side of the MACD indicators. And the reason is the volume was absent. The volume is coming back slightly today to the downside. So the bears have a point here, although a weaker point yet because we don't have a confirmation. The candle is bad. You can call it a shooting star, reverse hammer. It doesn't matter to me. It is a bearish candle. The problem is absent of confirmation. You could eat another pound in the face and they can gap the market higher again because we are still in the seasonality, the low volume seasonality. We're waiting for confirmation another day for sell-off before we say the bears again advantage here. Moving on to the Qs, 30 minutes chart. What's going on here? A little weaker than the SPY, but the good news is some of the overbought conditions of the RSI, certain charts are being worked out. You still have more work to do, and the question remains the same. Are we seeing a top in formation here? A bear flag formation could be. It is a weak one. We have yet to have a confirmation. If we have a confirmation, then we have the next support at 397. An important line, a very important support slash resistance level. It acts as a magnet to pull the chart down or pull it up. It is the center of gravity in this chart. And rest assured, before you know it, you're going to see a reading of 397 on the Qs once again. Here's a daily chart for the continuous contract on the Qs. What's going on here? The volume is recovering higher on the selling side. This is a bad sign for the bulls and a point to the bears. The problem is the bulls still have the advantage, the seasonality, and they're trading above the sloping line of resistance, now support. The momentum indicators are strengthening. They have reversed the negative divergence, and therefore the bears are gaining a slim advantage here. Of course, we're all awaiting the retest of that descending sloping line of resistance, now support. If we bounce from that line, assuming we have a sell-off tomorrow, then this is a good sign for the bulls. If we pierce below that line, it will be a good sign for the bears. And here's a chart for the IWM. What's going on here? We're trading above 223 in a bull flag formation. Today we saw the pop higher, but an immediate reversal right away. And now we have a formation of a bear flag, indicating that perhaps 223 will be retested as support. If it fails, we're looking down at 218. Moving on to the Dixie. What's going on here in the dollar index? index, no update whatsoever. We still have negative divergences on the momentum indicators, the RSI, the MACD. 96 remains support, so no update for now. What about gold? What's going on here? Not a good looking candle because gold traded higher and then closed at the lows of the day. Now the micro outlook remains bullish for gold because we have a bull flag pattern. We have momentum indicators that are strengthening for now. We are eyeing the next Fibonacci resistance at around 1,835. But the macro outlook for this pattern, at least, it could be a bear flag formation. If that happens, then gold will pull back and retest 1,763 for support. I would rather see that. If that line is confirmed for support once again, that will be a strong buy signal for gold. And I'm betting that gold will be one of the best ideas for 2022. Here's a chart for the 10-year yield. What's going on here? Perhaps that explains the pullback in gold, because gold has two enemies. Number one, the dollar, which did not do anything at all today. Number two, the 10-year yield. The 10-year yield moved higher today, and the question is what we're seeing right now? A bull flag formation, gathering energy after a higher low to pop above 1.5% for good. That certainly appears to be the case. Here's a weekly chart for the TLT. What's going on here? It is moving down below 149, not decisively, but the keyword is yet. We're waiting the weekly confirmation, the weekly closing. But even if that happens, it is a low volume, short trading week, even in the bond market. I shouldn't say short actually, because we're still trading Friday. But it is low volume. We had some auctions throughout the week, but the volume remains low. So we'll take whatever moves we have this week with a grain of salt. Here's a 4 hours chart for the VIX. What's going on here? It appeared midday that the VIX is bottoming and it's starting to move higher. We'll look at the MACD indicator. There is an imminent crossing to positive territory, creating green impressions on the histogram. If that happens, sooner or later the MACD will cross above zero, and that will induce another rally in the VIX. The problem is the closing candle for the day was down. It appears as a bear flag pattern. So we'll watch the VIX closely tomorrow. And of course, the important closing is the weekly closing. Will the VIX close above 20 or below it? Above 20, a good sign for the bears. Below 20 would be a good sign for the bulls. And here's a daily chart for Apple. What's going on here? It is stopping pretty much at the same target that we have identified before, the sloping line of resistance. It peaked a little above, but now it is facing that resistance. And look at the volume picking up higher on the selling side. The momentum indicators remain strong but elevated. They need a pullback. We know the sentiment and the drive behind buying call options in Apple keep pushing the stock higher. They want to see the headline of $3 trillion, like a bunch of babies. The problem is, if we get that headline, it will be a strong sell signal. Why? It has been a reliable pattern when Apple hit $1 trillion in 2018. Right after that, that was the top. And not just Apple, but the entire market went down with it in a steep correction. Likewise, when we got the $2 trillion headline, Apple went down in a steep correction along with the rest of the market. Are we going to get the $3 trillion headline, and then that will be the trigger for the upcoming correction? We'll see. What about Tesla daily chart for the souffle? Not a good closing candle here, but still the bulls are in the driver's seat for now unless we have a reversal candle. What is a reversal candle? We have to reverse at least 1 day worth of activities. That is yet to happen. But I want to illustrate the importance of these numbers, specifically 1,090.5. When we zoom into a 30-minute chart, you can see that 995 worked out as resistance and then as support. Very important line. Likewise, 1,090.5 also worked as resistance and then support. Again, another important line. The algos are respecting these lines. Here's what we're seeing right now. Formation of a bear flag. If that is the case, then Tesla will start to pull back starting tomorrow. 1,090.5 remains an important line. You can round that down to 1,090. Doesn't matter to me. If you see Tesla trading below that number, then you know the bear flag is playing out, and perhaps we will go down all the way to revisit 995. And here it is, moving on to two dips. BTC, Bitcoin. What's going on here? What a disappointment. We had the bull flag pattern. We had one bullish formation after the other. The source of bottom followed by bull flag. The problem is the technicals are just one component of what moves equities or any asset. You still have the mechanics and the fundamentals. Of course, the majority of the selling happened by agent traders and investors. So now we can comfortably remove the bull flag. And what are we looking at here? If the source of bottoming formation is breached, then we're looking back at 42,000 for support. Notice that the selling came at higher volume. So we have a confirmation here. The bearishness is strong. The action that we saw today is confirming. What does that mean? Higher volume. It confirms the move. The move higher came at lower volume. When you compare the move higher and lower volume versus the move down and higher volume, which one is the strongest? The answer is the move to the downside. And of course, I'm glad that I closed my Coinbase calls yesterday. That was the right call because Coinbase flushed down today along with other crypto-related equities. The trade is still profitable because we got in early. The problem is, look at this. These are the options, the call options with the weekly expiration date for Coinbase. I had the 265. This particular call was down over 70% today. Even if the trade remains profitable, it doesn't feel good after losing 70% from yesterday's gains. So the lesson is greed is not good. If you're holding calls or puts closer to expiration and you're up, the trade is profitable, take the profits. You can always buy back these calls if you like them and roll out, meaning you buy a longer expiration date. The problem is you cannot get your profits back. If you're down 70% from yesterday, you cannot get these profits back. But if you book the profits and the stock goes down, therefore the options, the call options also go down. You can always buy these options again at a discount, of course, if you still like them. And lastly, what about AMC? Yes, the name was down big today, but again, trading within range. The support 26, the resistance 32. So long as 26 is kept the support, we still hope that AMC could move higher. Losing 26, closing the week below 26 would be a really honest signal for the apes. The daily formations that we talked about yesterday, the reverse head and shoulder, perhaps the bull flag, are still intact, but the move has to happen before the end of the week because when you look at the weekly charts, the bear flag is still there. If the bear flag remains there, it's gonna play out, folks. You're gonna see a massive leg down in AMC. And lastly, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? Not a lot. We have pending home sales index. Today we got the case home chiller index, and again, home prices are up double digits year over year, but the rate of growth month over month slowed down slightly. So this will be an important indicator for the housing market, the pending home sales index. And with that, folks, we're done here. This is all I got for you for now. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow.
An enemy has been slain. Killing spree. Double kill. Your team has destroyed a turret. An ally has been slain. Your turret has been destroyed. The enemy's inhibitor is respawning.